As the stock market sags amid investor fears about coronavirus, mutual fund shareholders wonder how to avoid becoming collateral damage. Is cashing out of stocks and stock funds a smart way to protect their investments? Or should shareholders stay the course, stay fully invested? It's a classic strategic choice that's posed by the COVID-19 virus-fueled market pullback. While the market retreats, are you better off selling your stock fund shares and seeking safe havens in cash and bonds? Or is it better to wait out the storm, stay in your stock funds, and wait for the market to rebound? And people do react to headlines. China first reported that authorities were treating cases of coronavirus on December 31st. In January, although it is hard to say how much is due just to coronavirus impact fears, shareholders yanked a net $39.2 billion from long-term stock mutual funds in the U.S., according to the Investment Company Institute. That was more than calendar 2019's average monthly net outflow of $30.2 billion. With your individual stocks, you buy, hold, add or sell based on the rules of a time-tested strategy that tells you when to get in and out of securities. Are you a newcomer to investing who wants to buff up your stock investing skills? Check out this guide for stock market beginners. But what about the long-term mutual funds portion of your portfolio? It depends. You should treat various segments of your mutual fund portfolio differently, based on their purposes. Cashing out is a good strategy, sometimes if you have a segment of your mutual fund portfolio set aside to pay for goals that are approaching within a year or two, keep that segment in money market funds or other short-term assets whose value does not fluctuate much amid market volatility. Cashing out is what this segment of your portfolio is destined for. Likewise, if you're in retirement or close to it, cashing out whatever amount you need for an upcoming bill can be prudent. Stay the course with long-term funds is for the long-term portion of your mutual funds, the funds that you don't plan to liquidate anytime soon because they are devoted to an investment plan based on a long time horizon. Stay the course. You may ask, why? Why leave money in mutual funds that lose value in a downturn? The answer is that individual mutual fund investors rarely, if ever, get out of the market near its top. And they rarely, if ever, get back into the market at its bottom. For instance, in the 10 years ended December 31, 2015, the broad stock market in the form of the S&P 500 rose 7.31% on average each year. But by flitting into and out of the market in reaction to market ups and downs, the typical investor in U.S. stock mutual funds gained just 4.23% each year on average, according to research firm Dalbar. It's like expecting to win a road race despite dropping out. It can't be done. Sell low, buy high? Instead, time and again investors end up selling low, then buying high after missing the often explosive start to a rally. Meanwhile, if you simply stay put, stay invested, you benefit from the market's remarkable history. After all, the market has recovered from every downturn. And that includes the Great Depression, World War II and the financial crisis of 2008-2009. Cashing out can cost you the market's best days. The trouble with cashing out or seeking a safe haven in bonds is that people tend to get out at the wrong time and get back in at the wrong time. You're likely to miss the typically unpredictable starts of each new run-up in the market. Those tend to be among the market's best days. The price for missing out is that your total returns suffer. Market rallies start unexpectedly. Look what happened if you had invested $10,000 in the S&P 500 between the start of the year 2000 and last December 31st. If you stayed put, remaining fully invested through the market's ups and downs during those 20 years, your average annual return was 6.06%. Your nest egg would have ballooned into $32,421. But if you got cold feet, cashing out when the market got rocky, what happened? If you didn't get back in soon enough to benefit from rallies after various pullbacks, and you missed just the 10 best market days during that 20-year period, your average yearly return got slashed by more than half to just 2.44%, J.P. Morgan Asset Management calculates. Your end balance would have been a far more modest $20,030. The more best days that you miss, the worse your portfolio's investment returns would have been. If you missed just the 20 best market days, your rate of return would have shrunk to little more than break even, a mere 0.08% average annual gain. Your $10,000 would have turned into $10,167. If you missed the 30 best days, your return would have been negative. You would have lost money. Your $10,000 would have shrunk to $6,749. Is that a price you'd be willing to pay to protect your money? And it's all too easy to miss the best days after cashing out. 6 of the best 10 market days occurred within 2 weeks of the 10 worst days from 2000 and 2019. The single best day of 2015, August 26th, was just 2 days after the worst day, August 24th. But once a rally begins, it's only human nature to wait for some sign that the rebound is for real and not just some dead cat bounce. Unfortunately, staying on the sidelines like that, thinking you're playing it safe, ends up costing you money. Please like, share, and subscribe to our channel.